Welcome to the Tuesday Target Audio Edition. I'm Constantine.
And I'm Penelope. Today we are unpacking Week 11 of Juri von Randow's newsletter, Meme-Grade Crude and Unprintable Food.
First, a quick alert for Elite Trader subscribers. The Oracle Egyptian Camel trade requires immediate closing today. Make sure you execute that exit.
Now, let's get into the absolute madness in the oil market. WTI crude just pulled off a historic $38 intraday round trip. It spiked to $119 on the open. Then, a single presidential phone interview crashed it below 82.
Yeah, pretty insane. Crude fell harder than any OPEC decision in history. Retail traders jumped into the USO ETF right near the top. They treated it like a speculative token launch, smashed the all-time volume record, and watched their positions evaporate before the closing bell.
Absolutely. Oil operates as a headline-driven slot machine right now. It surges 30% on a drone strike and drops 25% on a tweet. By the close, the tape looks completely flat. The herd looks at that flat ticker and assumes the crisis has passed.
The physical reality tells a much darker story. We have to look at the global fertilizer trade. Roughly 45% of it ships through that exact same blockaded strait.
That's correct. Urea futures are already screaming higher. When fertilizer gets expensive, the entire food chain feels the impact. Corn, soybeans, wheat, everything goes up. A social media post can crash crude oil in 40 minutes. A disrupted planting season stays ruined for months, regardless of any political ceasefire.
Or as Juri phrases it, crude swing make for dramatic tickers, but food inflation makes history.
Exactly. And if this blockade drags on, Washington might float a ban on U.S. petroleum exports. They want to trap WTI crude at home to suppress domestic pump prices for the midterms.
That move throws allies under the bus. It also sends global Brent crude parabolic. For traders, it creates a structural spread divergence and a potentially great trading opportunity.
Policymakers will likely try to release strategic reserves to calm the panic. Emergency barrels serve purely as a temporary sedative. They buy policymakers a few calm sessions. They completely fail to fix the real bottleneck. Shipping risk, tanker availability, and skyrocketing freight insurance dictate the actual terms on the water.
We also have to watch the market mechanics. Systematic funds and trend followers remain a massive swing factor. They are primed to sell significant equity exposure in a flat or weak tape. Mechanical flows amplify these geopolitical headlines and create outsized market reactions.
At the same time, retail participation remains stubbornly strong. Individual investors keep buying the dip. This constant buying temporarily stabilizes the market. It also delays the not unlikely flush, leaving the tape highly vulnerable to sudden air pockets later on.
Let's pivot to the economic calendar. We have February Consumer Price Index on Wednesday, followed by Friday's core PCE, personal income, and durable goods.
Yes, and the fun part, every single one of those data points arrives completely outdated. They miss the recent oil shock entirely. The only metric worth watching is Friday's Michigan Sentiment Survey. We need to see if consumers are already pricing in $5 gas.
This brings us to Juri's tactics for the tape. Volatility is elevated. Gamma is deeply negative. Headlines reverse trends in minutes. This environment demands strict risk management.
Keep your position sizes small and hedge with defined risk structures. Resist the urge to chase intraday reversals driven by presidential tweets. The best trades pay you whether the war ends tomorrow or drags into the spring.
That leads us to the Tuesday target play, CF Industries. Ticker CF.
Sure. And why? Well, CF Industries manufactures ammonia and urea using cheap U.S. natural gas. They sell into a global market where competitor input costs are absolutely exploding.
Their margins widen on both sides. Domestic costs remain stable while international product prices skyrocket. A bull call spread on CF captures this structural cost divergence with strictly defined risk.
Disrupted fertilizer supply chains take months to normalize. This provides a highly stable setup compared to the chaos in crude oil.
Remember, this is just food for thought. You can find the official trade entries and behind-the-scenes logic in the Trade Alerts section on MacroDozer.
And if you want to tame these wild market swings, check out the Elite Trader Plan or book a one-on-one mentorship call with Juri. The links are right there in the newsletter.
Thanks for listening. Stay sharp, manage your risk, and we will catch you next week.